Thank you for being courteous.
Of course. If we could call the hearing to order. We'll proceed in the usual fashion with opening statements by myself and Ranking Member Grassley, followed by my introduction of the three witnesses, and then each of you have 5 minutes to make your opening statement. Your full testimony will be made a part of the record. I urge you to confine your remarks to those 5 minutes so we have a chance to engage with you. And I also want to welcome Chair Murray and Senator Braun to the committee hearing. This is about the tax injustices that are presently baked into our tax code. As everybody knows, there are two sides to the budget: spending and revenues. And while some of our colleagues only want to look at the spending side, the U.S. has never run a balanced budget in the modern era without revenues nearing 20% of GDP. And of course, most revenues come through the tax system. Today's hearing will tell of two distinct sets of tax rules that produce a rigged, corrupted, and deficient tax system. Under one set of rules, for most Americans, paying taxes is immediate and automatic. Taxes are withheld from every paycheck to fund the public goods that contribute to our happiness and security: roads, schools, parks, veterans care, the military. Under this set of rules, taxes also are paid on all income for Social Security and Medicare, programs that let Americans retire with dignity and afford medical care. Under these rules, a typical teacher or iron worker in Rhode Island might pay a federal tax rate over 20%, as would a married couple running a small business earning salaries of $150,000 a year. But it's different rules for the wealthy and well-connected. Billionaires and large multinational corporations get special rules that let them pick when and even if they pay taxes. This corrupted tax code lets billionaires pay an average tax rate of just 8.2%, less than half the rate of a typical teacher or firefighter. Thanks to the Trump tax law, large multinational corporations average even less, just 7.8%. Some pay zero. Simple fairness is reason enough to end this rigged system. But the tax dodging also blows a hole in our federal budget. The Center for American Progress reports that tax cuts for the wealthy have been a primary driver of deficits for decades, accounting for more than half of the debt increase as a share of the economy. Letting wealthy business owners avoid Medicare taxes on their full income costs Medicare $250 billion in lost revenue. Letting billionaires pay low or zero tax rates costs America $550 billion. Letting multinational corporations shift profits to tax havens leaves a $1 trillion bill for everyone else to pay. Common sense reforms can make our tax code fairer while reducing the deficit. First, to protect the long-term solvency of Social Security and Medicare, I'm filing legislation to require contributions to Social Security taxes on high-end income. Right now, the cap on contributions means someone making $1 million effectively stopped paying into Social Security February 28th of this year. People living on investment income pay no Social Security contribution. Respecting the Biden tax pledge, my Medicare and Social Security Fair Share Act will require Social Security contributions on all income above $400,000, however earned. This legislation includes the Biden budget tax plan we saw to extend the solvency of Medicare by 20 years. Second, billionaire Warren Buffett famously highlighted the rigged tax code by pointing out that he paid a lower tax rate than his secretary. So I'm also reintroducing the Paying a Fair Share Act to codify the so-called Buffett rule with a minimum 30% tax rate beginning on income over $1 million per year, whatever the source. Third, American multinationals recently reported $60 billion in profits in the Cayman Islands in a single year. 10 times the size of that entire economy. That is a scam. It costs American jobs, and it's very unfair to American businesses, large and small, that don't engage in overseas tax games. My No Tax Breaks for Outsourcing Act would make offshoring companies pay the same tax rate domestic companies pay here at home. House MAGA Republicans have yet to release a budget for the American people to see, but they've sure made clear who they want to protect. Their first vote was to protect wealthy tax cheats by hobbling IRS enforcement, adding $114 billion to the debt. Then they filed legislation to make the Trump tax cuts permanent, a $3 trillion cost with over 40% of the benefit to the top 5% in income. Some have even proposed a new 30% sales tax on everything. The Conservative American Enterprise Institute says this all could add $18 trillion of debt. Behind all this secrecy and mischief lurks a crew of Republican dark money donors who don't want to pay taxes and are so rich they don't care about Medicare, Social Security, or the economic well-being of wage earners. Selling their poison to the public is hard. But if you put Americans' priorities first, it gets pretty easy. And the math works. So I look forward to hearing the testimony today about fixing a tax system rigged for wealthy political donors. And I turn now to our distinguished ranking member, Senator Grassley.
Republicans know that Social Security and Medicare are part of the social fabric of America, and we're committed to maintaining it as that part of social fabric. And we also know that it needs to be dealt with sooner than later, because the sooner it's dealt with, the easier it's going to be handled than if we wait too long, as Reagan and Tip O'Neill did in 1983 when it was about busted. But they made a bipartisan decision that probably at the time they thought it was maybe only good for a couple decades, but it's turning out to be an agreement that has kept Social Security as a sound program through at least 2033. So let's hope that we don't wait as long as they did to find a solution to it. And when we do find a solution to it, that it's good for the next 60 years. So, Mr. Chairman, I thank you for holding this hearing today. Revenues to the federal government are a fundamental part of the budget and a subject that this committee ought to be studying. However, I want to stress that the fundamental problem that we have in the federal budget is not one of undertaxation, but overspending. And I hope through this day that I'll be able to show that as a necessary part of what we're doing. The last time the federal budget was balanced was in 2001. Revenues at that time were 18.9% of gross domestic product. Last year, federal revenues amounted to 19.6% GDP. Yet, we still managed to run a deficit of 1 4/10 trillion. That's because even though tax collections have increased by 2 9/10 trillion since 2001, spending has grown by 4.4 trillion. Another issue that we should address is the difference between tax avoidance and tax evasion. Tax avoidance is the legal minimization of tax liability. Tax evasion is the failure to pay taxes that everybody knows you owe, including the taxpayer. Tax evasion is a crime. Tax avoidance is legal and frequently encouraged by Congress. The tax code is full of various credits, deductions, and other incentives that are usually tied to a behavior Congress decided to incentivize. In fact, taxpayers have a right to pay only what tax is legally due. It's also important to remember that a tax loophole is an ambiguity in the law exploited in a way not intended or foreseen. It's not simply a policy with which one disagrees. When it comes to closing actual loopholes and cracking down on tax cheats, my record as a former chairman and/or ranking member of Finance Committee is second to none. One only needs to look at my investigation uncovering tax cheats in the Conservation Easement Program and my creation of the IRS Whistleblower Office has reclaimed billions from tax fraud, to name just two examples. And that bill passed in 2005, I think, would add up to about $6 billion coming in as a result of that legislation. I also want to stress that the U.S. has a progressive tax system. Nothing I think members on the other side of the aisle is willing to look at. But we have an analysis published by the Biden Treasury Department that quote unquote has these words in between the quotes. Total federal taxes are progressive. Families at the bottom of the income spectrum often have a negative federal tax liability due to refundable credits. In contrast, those in the top 1% pay close to 1/3 of their income in federal taxes. Nonpartisan experts at the Congressional Budget Office and the Joint Committee on Taxation have come to similar conclusions. So have outside groups like the Tax Foundation and the Tax Policy Center. IRS data also bears out the progressive nature of our tax system. Based on tax year 2020 returns, the top 1% of the taxpayers by adjusted gross income paid more than 42% of the total federal income tax. Now, some people would say 42% isn't enough. I'd like to have somebody that says it's not enough. When is enough enough? I have a hard time getting an answer to that question. If it's 43%, maybe we'll join you in doing it if we can have a stop to the demagoguery that goes on arguing about that. Congress should regularly examine tax incentives, just as we should review spending programs to ensure that we're working, that they are working as we intend. If my Democrat colleagues are on the hunt for tax subsidies that benefit large corporations and the wealthy, they need look no further than legislation that was enacted on a purely partisan basis just last August. Their ill-named Inflation Reduction Act included hundreds of billions of dollars in new or expanded tax incentives. Included in this legislation are novel new tax features such as quote-unquote direct pay and quote-unquote transferability. We had to deal with that in the 1980s and intended to be a really bad policy that 2 years later we changed. That actually made it, now this direct pay and transferability actually made it easier for corporations and wealthy investors to pay little or no tax. These provisions will not only further complicate the tax code and primarily benefit the affluent, but recent estimates suggest their costs could be far greater than Congress was originally led to believe. We helped create the tax avoidance problem, and last year's Democrat made it even worse. As one former Finance Committee chairman used to say, quote, many taxpayers accept complexity that favors them, end of quote. If we really want to diminish the advantage that wealthy taxpayers and large corporations have, we should address the complexity of the tax code. This is a bipartisan problem, but fortunately solving it is within our control. Thank you.
Thank you, Senator Grassley, and agreed on the complexity problem. I want to welcome the witnesses. Dr. Kim Klausing is the Eric M. Zolt Chair in Tax Law and Policy at the University of California, Los Angeles. Klausing is an economist who previously served as the Deputy Assistant Secretary for Tax Analysis at Treasury. She is an expert on international corporate profit shifting. Kind of unfortunate there has to be expertise in that particular behavior, but there we are. Our second witness is Dr. Danny Yegan, who is an associate professor of economics at the University of California, Berkeley, and research associate with the National Bureau of Economic Research. Yegan previously served as the chief economist at the Office of Management and Budget. His research focuses on the individual income tax and taxation of capital gains. Dr. William McBride is the Vice President of Federal Tax Policy and Stephen J. Enton Fellow in Economics at the Tax Foundation, where he leads efforts to research, model, and reform the U.S. tax code. While at PricewaterhouseCoopers, Dr. McBride conducted economic impact and general quantitative analyses and researched the economics of taxation and issues related to tax reform at the state, federal, and international levels. In a prior stint at the Tax Foundation, he wrote extensively on the economics of taxation, particularly regarding business investment. Dr. McBride holds a Bachelor of Science in Electrical Engineering and a Bachelor of Science in Physics and a PhD in Economics. I welcome you all, and why don't we begin with Dr. Klausing and proceed across the table.
Chairman Whitehouse, Ranking Member Grassley, members of the committee, thank you so much for inviting me today to share my views on corporate tax avoidance. In my testimony today, I will discuss 4 key flaws in U.S. law, and I will suggest simple reforms that can improve the tax system across those dimensions. First, current law contains large tax preferences for offshoring and profit shifting. Imagine the incentives of a U.S. multinational company. If it earns income in Iowa or Rhode Island, it pays tax from the first dollar at 21%. On the other hand, if it earns income in a zero tax rate jurisdiction abroad, the first 10% return on tangible assets is completely free of U.S. tax, and the return above that is taxed at a 50% discount relative to U.S. income. This provides a large incentive to earn income offshore rather than in the United States. Somewhat astonishingly, there's even an incentive to earn income in France or Japan relative to the United States, and those are both countries with a higher corporate tax rate. The reason is if you earn income in France or Japan, you accumulate tax credits, which you can use to offset the income that would have been due on the zero tax rate jurisdiction income. This means that a savvy taxpayer can blend income from high tax and low tax jurisdictions and get to a rate that's approximately half the U.S. rate. I often call this an America Last tax system, since all foreign income is preferred to U.S. income. And in my written testimony, I show that this system has large effects on the behavior of U.S. multinational companies. A second flaw in the current system is that we forego large amounts of tax revenue by failing to reform it. If you look at scores from JCT or Treasury, you'll see that there are hundreds of billions of dollars available and left on the table from not fixing these offshoring and profit-shifting incentives. A third flaw in the current system is that it favors large multinational companies relative to small businesses. And these large companies often wield significant market power. These tax preferences reduce the ability of small businesses to compete in a fair and level playing field with big businesses. U.S. multinationals often pay single-digit tax rates, far lower than those faced by smaller businesses. And a tax system that favors the big companies relative to the small companies will tax economic rents or profits above the normal rate at a much lower rate than the normal profits. And economists on both the right and the left of the political spectrum agree that it's more efficient to tax these above normal profits than to tax normal returns to capital. A final flaw in the current system is that corporate tax avoidance reduces the fairness of our tax system. It benefits corporate shareholders at the expense of middle-class taxpayers. In recent decades, corporate profits have been much higher as a share of the economy at the same time that the labor share of income has shrunk and economic inequality has increased substantially. Our tax system too often turbocharges these trends by lowering the tax burden on capital income and on rents and disproportionately targeting tax cuts towards the top of the distribution. Fortunately, there are reforms at the ready that can address these flaws in the current law. And Senator Whitehouse's proposal and his sponsored legislation shows one promising path forward. For example, the No Tax Breaks for Outsourcing Act would end the offshoring incentives that are baked into current law, raising revenue in a fair and efficient manner. These reforms are consistent with the spirit of the international tax reforms that have been suggested by the Biden administration. And we should note that international tax reform just got a lot easier than it used to be because many other countries are in the process of implementing strong country-by-country minimum taxes. This means that U.S. reforms will not disadvantage U.S. companies, and they will better align with what the rest of the world is doing. Today, the U.S. is facing a challenging fiscal situation. As I detail in my testimony, large deficits and debt require fiscal responsibility, and this means looking for new sources of tax revenue. Spending cuts alone will not be sufficient. In this regard, I would also commend Senator Whitehouse for his great leadership on climate, alongside several of his peers on this committee. Congress took important action on the climate through the Inflation Reduction Act. These policies are an important step forward for climate change mitigation. In the future, these steps will be even more effective if they are accompanied by legislative measures that levy a fee on carbon emissions and that end the fossil fuel subsidies that are already in our current tax code. A carbon fee can easily be designed to avoid adverse consequences on consumers, and it would be an enormously effective tool to combat carbon emissions while raising much-needed revenue at the same time. Thanks.
Thank you very much, Professor. Dr. Yegan.
Chairman Whitehouse, Ranking Member Grassley, and members of the committee, thank you for the opportunity to testify before you. Today on tax day, I describe two simple ways that the wealthy legally avoid taxes and how curbing them would raise $750 billion to pay for congressional priorities and protect our fiscal path. First, the wealthy often label their income in ways that trigger less tax. The quote, Gingrich-Edwards loophole, so named after two prominent users, is a focus of Chairman Whitehouse's new bill today and also my academic research. The Gingrich-Edwards loophole enables high-end workers to classify their labor income as what is called, quote, pass-through income, and thereby escape Medicare taxes. Co-authors and I have shown that U.S. top earners are dominated by lawyers, consultants, and also managers of everyday medium-sized businesses like car dealership chains and beverage distributors. If you're a lawyer, consultant, or a business manager and get paid in W-2 wages like the rest of us, you owe Medicare taxes on that income. But if you do that same work and also own part of the business you work at, you can get paid in Schedule E pass-through income and thereby escape Medicare taxes. Same labor income, but labeled in a way that triggers less tax. The result is what the Treasury Inspector General has called a, quote, multi-billion-dollar employment tax shelter, end quote, that is unavailable to everyday Americans. Closing the Gingrich-Edwards loophole for high-end workers would raise $306 billion over the next 10 years. Second, in research now forthcoming in the Oxford Review of Economic Policy, Greg Leiserson and I estimated that the Forbes 400 wealthiest Americans from 2010 to 2018 paid an average federal individual income tax rate of 8% on their full income, including capital gains on unsold stock. How is that possible? Top business owners make most of their income in the form of rising stock values. They do not pay individual income tax on that income until they sell. And if they never sell, and instead bequeath the stock to their heirs, no one ever pays income tax on those billions of, quote, unrealized capital gains. Think of two people who created enormous personal wealth during their lifetimes: entertainer Frank Sinatra and Walmart owner Sam Walton. At current federal tax rates, Frank Sinatra would pay about 40% in federal income tax on his wage income, much more than Sam Walton would pay on his stock income under low effective individual tax rates, even after factoring in corporate income taxes. Congress has three options for raising effective tax rates on top business owners and closing the gap between a Sinatra tax burden and a Walton tax burden. It can raise effective corporate income tax rates, raise dividend and capital gains rates, or broaden the capital gains tax base by taxing unrealized gains, as in Senator Wyden's billionaire's income tax proposal. Here, I will discuss that proposal's child, President Biden's billionaire minimum income tax, which has 55 co-sponsors in the House, would cover the 20,000 households with wealth over $100 million, and in its latest version, would raise $436 billion over 10 years. My written testimony contains a plain English FAQ, but here's how the minimum tax would work. If a covered household is already paying 25% of their income, including unrealized gains, like, say, a star entertainer earning wages, they would pay no extra tax. But if tax-free unrealized gains allows them to pay less than 25%, they would owe a top-up payment to meet the 25% minimum. Those top-up payments could be paid over 5 to 9 years and would be a prepayment of capital gains tax owed upon sale, gift, or bequest. Charity would be exempt. Illiquid taxpayers could opt out of prepayments on their private stock gains and instead pay later with interest. Slow and partial prepayment on public stock gains, combined with prepayments from liquid taxpayers on their private stock gains, would preserve incentives to take companies public. The minimum tax is flexible and makes space for compromise. For example, Congress could dial the minimum tax rate down to 15%. Entrepreneurs taking a company public could be granted 20 years to pay. Thank you. I look forward to your questions.
Thank you, Professor. And Dr. McBride.
Thank you, Chairman Whitehouse, Ranking Member Grassley, and members of the committee. I appreciate the opportunity to speak with you. My testimony will focus on the size and distribution of the federal tax burden. Last year, the federal government collected an all-time high of $4.9 trillion in taxes. At 19.6% of GDP, this is the highest level in 22 years. And prior to that, World War II. The largest source of revenue for the federal government is individual income taxes, which surged 29% last year to reach $2.6 trillion, or 10.5% of GDP, the highest level on record. This is partly explained by surging capital gains revenue and partly by the longer-term rise of pass-through business income. Now about half of business income is taxed under the individual income tax code, as owners of partnerships, S corporations, and other pass-through businesses report profits on their individual income tax returns. The remainder of business income is subject to the corporate income tax. Nonetheless, corporate income tax collections last year also came in at an all-time high of $425 billion. As a share of GDP, corporate income tax collections reached 1.7%, about equal to the average level for the last 30 years. Combined, corporate and individual income taxes reached 12.2% of GDP last year. That's the highest level in over 50 years. Most of the federal income tax burden is paid by high earners, as is the majority of the entire federal tax burden. According to the latest IRS data, of all federal individual income taxes collected, the top 5% of individual taxpayers paid a 62.7% share, while the top 1% of individual taxpayers paid a 42.3% share, a larger share than the bottom 95% of individual taxpayers combined. The top 1% share of taxes is the highest in at least 20 years. High-income taxpayers also pay the highest tax rates, according to the IRS. The average individual income tax rate in 2020 was 13.6%. The top 5% of taxpayers paid a 22.4% average tax rate, while the top 1% of taxpayers paid a 26% average rate, more than 8 times higher than the average rate paid by the bottom half of taxpayers. When accounting for all federal taxes, including taxes on corporate income, payroll, estates, and other sources, the federal tax code remains very progressive. According to the latest data from the CBO, the top 1% of households paid about 25% of all federal taxes in 2019 and had an average federal tax rate of 30%. In contrast, the bottom 20% of households paid about 0.1% of all federal taxes and had an average federal tax rate of 0.5%. There's nothing simple about the way in which the federal government collects these taxes. especially individual and business income taxes, which in many ways are inherently complex, and various credits and preferences add to the complexity. The tax code currently totals about 4 million words, such that no taxpayer can reasonably be expected to fully comprehend it. In 2022, Americans spent more than 6.5 billion hours trying to comply with the tax code, equating to about $313 billion a year in lost productivity. This does not include the cost of tax planning or of uncertainty in the law, which makes planning for taxes as well as investment in other economic activities difficult and costly. The increasing complexity of the tax code has contributed to an overwhelming administrative challenge for the IRS. Last year, for instance, the IRS answered only about 13% of the 173 million phone calls it received from taxpayers asking for help. There are also the substantial and well-documented economic cost of high marginal income tax rates arising from disincentives to work, save, and invest. For instance, researchers at the OECD examined data from 63 countries and concluded that corporate income taxes are the most economically damaging way to raise revenue, followed by individual income taxes, then consumption taxes, and property taxes. One of the most problematic and economically destructive aspects of the U.S. tax code is the double taxation of corporate income. First by the corporate income tax, and now also the book minimum tax, and then by shareholder taxes on capital gains and dividends, yielding a combined top tax rate that approaches 50% after accounting for federal and state corporate and individual income taxes. In short, we as a country have built a federal tax system that is inherently complex, costly, and controversial. To the extent it is comprehensible at all, taxpayers do not perceive it as fair. The IRS has real challenges administering such a complicated tax system, but boosting the IRS budget will not fix the underlying problem that causes millions of taxpayer calls to the IRS every year seeking help. As top priority, lawmakers should simplify the tax code so that taxpayers can understand the laws and the IRS can administer them with minimum cost and frustration. Second, lawmakers should reduce the economic drag caused by the tax code, particularly as economic growth is expected to slow to a halt this year, according to the CBO. My written testimony outlines certain revenue-neutral reforms that would greatly simplify the tax code and improve economic growth. I'm happy to discuss those further in follow-up questions. Thank you for your time and attention.
Thanks very much. One of the things that I have experienced in my time in the Senate is the extent to which Congress is responsive to big special interests and to extremely wealthy individuals. And my experience is echoed by academic studies that show there's zero statistical significance to what the public wants and what Congress does, and very high statistical significance between what wealthy individuals and special interests want and what Congress does. And I watched that get dramatically worse after the Citizens United decision, when wealthy special interests could spend unlimited amounts of money in politics and even hide that it was them, so that money flows through anonymizers like Donors Trust, which Dr. McBride is a big donor to your organization, and you don't know who's really behind it. So this combination of huge amounts of political money flowing into the system from big special interests kept secret from the American public has dramatically added to the long-term difficulty of trying to have fairness in Congress. And I see it particularly in the tax code. We fight a lot about the appropriated budget, but if you can get something into the tax code, you don't have to fight for that appropriation the next year. It's in. And it's buried in the complexity that Dr. McBride and our ranking member have talked about. And so it's largely hidden. And rooting it out is extremely, extremely challenging. But what you end up with is a tax system that I think is extremely unfair. Dr. McBride just said that the top 1% pay 25% of the federal taxes. Did I have that number correctly? Well, they get 22% of the national income. If you believe in a progressive tax system, they should be paying a lot more than 25%, because when 1% of the population gets 22% of the entire country's income, more than the entire lower 50%, that is such a massive economic dislocation that you would think that reasonable progressive tax rates would address that. And instead, it's the opposite. A florist in Cranston, a pizza shop owner in the east side of Providence, a small business selling goods to tourists in Newport, Rhode Island, will pay a higher tax rate than the biggest taxpayers. And what rolls into this is this question of offshoring and profit shifting. And I'd like to ask Dr. Klausing to talk a little bit more about who takes advantage of it. Does the florist, the retail shop, and the pizza guy take advantage of being able to relocate profits to the Cayman Islands or like Apple to Ireland and duck taxes? Or do they have to face competition from big mega corporate chains that may be selling flowers across the internet, that may be selling frozen pizza in markets, that may be retailing through Amazon sales, and is able to charge lower prices because they've hidden their actual income and are paying lower tax rates, cheating the small business community at the expense of big business?
Yes, you're exactly right, Senator Whitehouse, that multinational companies can take advantage of their multinational structure to shift income offshore, and that gives them an enormous tax break relative to small domestic companies.
Which they can put into a pricing advantage and crush small businesses with a pricing advantage that they only got by hiding revenue offshore.
Absolutely. And if you look at the corporate community in the United States, about 500,000 taxpayers file as C Corps. And really, there are fewer than 2,000 of them that account for about 80% of the base. So that corporate base is also very concentrated. You talked about the individual income being very concentrated at the top. This is also true among the business community. And just like our individual tax code favors capital income by those earned at the very top, our corporate system also favors the income of the very few taxpayers that control the vast majority of the activity.
And I would argue control the vast majority of the political activity that creates these glitches in the tax code that disadvantage regular people in favor of the billionaires and the big wealthy special interests behind the glitches. With that, let me turn to my distinguished ranking member. We'll probably do a second round, and then Senator Kaine, I believe, is next, unless we have a return of an earlier member of the committee. Senator Grassley, you are recognized.
Thank you. If I could, just as a matter of saying how I've made my point that there's a lot of things in the tax code that anybody can take advantage of, we have the Gingrich-Edwards loophole, and I think I ought to point out that it's been very public. It's a matter of public record that President Biden himself aggressively took advantage of it to save himself as much as $500,000. I want to ask my first question of Dr. McBride. Some have argued that the Tax Cut and Jobs Act advantaged multinational companies at the expense of U.S. domestic companies. However, recent studies by researchers at Duke University and elsewhere actually found tax reform primarily benefited domestic firms and likely reduced incentives to shift earnings overseas. I'd like to have you elaborate on whether or not our tax reform laws, that specific law, encourage more business investment in the United States.
Certainly. That was the purpose of the law. The Tax Cuts and Jobs Act explicit purpose was to incentivize greater investment and to deal with, in particular, with the very high corporate tax rate that existed prior to the law, at 35% federal corporate tax rate that combined with state corporate taxes that gave the U.S. The highest corporate tax rate in the OECD, and that corresponded to high effective tax rates as well, according to several studies. It resulted in all sorts of distortions and behaviors that were very clear, showing up in news stories of the day. I was studying tax at the time at Tax Foundation and seeing the wave of inversions, for instance, that were occurring in direct response to that very high corporate tax rate. Inversions are where corporations change their location of their headquarters for tax purposes. So major brand name companies in the U.S. were changing their headquarters locations to exit the U.S. And get out from under the very high corporate tax rate, as well as the burdensome tax on foreign income that applied prior to the law. So there was also an attempt to address that effect that was causing, for instance, corporate profits to be locked out of the U.S. and a variety of games being played in regards to foreign income. So there were reforms there as well. Not entirely simple reforms, as our witnesses have discussed. There's certainly some complicated features of the GILTI provision in particular. But nonetheless, the goal was to address that very clear problem that was recognized on a bipartisan basis by the Obama administration, for instance. We had a real problem with competitiveness in the corporate tax, and the solution was to get the corporate tax rate down to somewhere close to the middle of the range found in OECD countries, and that meant bringing it down dramatically. So it's at 21% currently, and including state-level corporate taxes, giving the combined rate somewhere close to 26%. That remains slightly above average for OECD countries, which in the OECD, the average is about 24%. The average EU country has a corporate tax rate of about 22%, I believe. So that was an effective way, and really the only way, to effectively deal with the very bad competitive situation the U.S. was facing due to our corporate tax. So the law succeeded in that regard, did lots of other things, but that was its major success, I would say. The CBO, for instance, and several other researchers, including us and other modelers, found that the effect of that, in particular lowering the corporate tax rate, as well as improving the base of the corporate tax and the pass-through business tax, improving the base by allowing companies to immediately write off investment in equipment. That's bonus depreciation. So improving the base of the tax and lowering rates combined had the effect of lowering the marginal effective tax rate on investment in the U.S., on domestic investment. So the prediction, according to the CBO, us and others, was that this would boost investment. And that's in fact what we saw. In 2018, there was a large surge in investment, particularly in IP investment. It faded towards the end of 2018 and into 2019. There's several other policies, of course, that confound the issue, other policies and other issues. One was the trade war that was kicked off in 2018, as well as the higher tax rates implemented by the Fed, interest rates by the Fed. And then, of course, in subsequent years, we had all sorts of other confounding effects, including a pandemic. But we can look at the pre-pandemic year of 2019 and see that the economy was in fantastic shape, actually, by many measures. Not very difficult to identify what portion of that is attributable to the law, to the tax law. But there was, in fact, the lowest unemployment rate in 50 years, particularly low, lowest on record for minorities. And for instance, real wages were growing at the fastest pace in over a decade. So very, very clear the economy was in great shape following the law, but again, empirically very difficult to identify what portion of that is attributable to the Tax Cuts and Jobs Act.
Senator Kane.
Thank you, Mr. Chair, and thanks to the witnesses. Today is tax day, so let me start with a softball. Should policymakers be concerned about or prioritize efforts to enable the IRS to be more customer responsive in helping people file tax returns and getting their questions answered in a prompt way?
Absolutely. Yeah, I don't know if you want a longer answer on that.
No, one word answer is fine.
100%.
Yep. Dr. McBride.
Completely agree.
Good. Okay, so we all agree on that. Well, here's a bit of good news, Mr. Chair. The Fiscal Times today has an article that says IRS cites big improvement in customer service. I'd like to introduce it for the record.
Without objection.
And let me just read the most important quote. The average wait time for callers looking for help from the IRS has fallen to 4 minutes this year, the Treasury Department said Monday. The average wait time was 27 minutes last year when the tax agency earned its worst customer service ratings on record. The Treasury Department attributed the improvement to the additional funding it received from Congress this year, quote, thanks to the 5,000 new hires already made possible by the Inflation Reduction Act. IRS customer service representatives answered more than 6.5 million taxpayer calls this year, which is 2.4 million more live calls than during the same period last year. The IRA provisions dealing with the IRS got some attention, particularly the enforcement provision. I was a strong supporter of those because in 10 years in the Senate, I've had a lot of Virginians complain about responsiveness because we've been underfunding the IRS. I'm hearing anecdotally on the road in the last 2 weeks, and my staff is too, that the IRS has dramatically improved. Dropping wait times on phone calls from 27 minutes to 4 minutes is a pretty good indication that's going on. More to do, but I'm heartened to see it. I'd like to ask a question about carried interest, and maybe I'll start with you, Dr. Yegan. I have never understood the economic rationale for the dramatically discounted tax rate applied to carried interest with respect to wages and salary. Do you agree with me that there's no good reason to give such a steep discount to folks who earn their income via carried interest?
Thank you, Senator. Yes, similar income should be taxed similarly. For labor income of teachers, of senators, of professors, we all make income from our labor. We face ordinary income tax rates. And it's a principle of economics of taxation that if you don't tax similar income similarly, you induce economic distortions that raise the economic burden per dollar of revenue that the Treasury gets to take in. And that's bad. Hedge fund managers work for a living, and that's labor income. It should be taxed at ordinary rates.
Others want to know weighing on that, Dr. Clausing or Dr. McBride?
I agree completely with Professor Yegan.
Dr. McBride?
I think the carried interest issue is a complicated one. There's several different scenarios. It's not just hedge funds that are using this provision. I know, for instance, there's a local restaurant chain that used this provision from years ago to set up. This is a way to share profits for folks that fund startup companies of all sizes. I think you have to be careful in trying to address this provision so that it doesn't have the knock-on effects of hurting startups and other entrepreneurship. But agree generally with the principle that one clear way to simplify the tax code would be to tax all sources of income at the same rate. Mm-hmm. We do have recently analyzed a proposal that does that. It taxes both capital income and labor income at the same rate, 20% in particular. This has a lot of good qualities. It leads to a lot of simplification, a lot of administrative simplification.
I very much support simplification strategies. I still think having it progressive would make sense, but I'd like to treat income as income and eliminate the distortions that Dr. Yegan testified to. I'm a co-sponsor of a bill that Senator Baldwin has that would equalize the carried interest tax rate. I know the chairman has a bill that would do the same thing in a slightly different way. I hope we might be able to do that. I think it would be a really efficient way to promote equity and also raise revenue that could be used for valuable priorities like childcare or other things that are frankly very needed to get people back in the workforce today. With that, I'm at the end of my time. I yield back, Mr. Chair.
Senator Murray.
Thank you very much, Chairman Whitehouse, for holding this important hearing. I know there's a lot of hardworking families in my home state of Washington who are doing their part. They're playing by the rules, paying their fair share in taxes. they deserve to know that everyone else is as well. There really is no reason that an investor on Wall Street should be paying less in taxes than a firefighter in Spokane or a nurse in Seattle. And there really is no reason that companies making billions in profit should pay less in taxes than mom and pop stores across Washington State or across the country. It's not fair, and I don't think it's American. We really need to close the loopholes and make sure that the wealthy pay their fair share. And we need to make sure they play by the same set of rules as everyone else. I just don't think that's controversial. And yet some Republicans, as we know, have constantly pushed for bigger corporate handouts and bigger loopholes and giveaways to the wealthy that they can take advantage of. In fact, the Trump tax bill was chock full of freebies and handouts for those at the top, lined the pocket of Wall Street and loaded the national credit card with trillions in debt. And still after that debacle, when it came time to raise the debt ceiling under the last president, Congress did the responsible thing. We worked together in a bipartisan way to raise the limit like we've done so many times before and like we should do again now. The full faith and credit of the United States should never be held hostage to score political points, period. Now, in stark contrast to the Trump tax giveaway for the rich and wealthy, I'm very proud that Democrats were able to pass steps in the Inflation Reduction Act to help working families by lowering costs and leveling the playing field. And that included steps like making sure billion-dollar companies who are paying at least the same 15% tax rate as small businesses already pay, taxing stock buyback schemes that enrich Wall Street executives, and getting the IRS, as my colleague just alluded to, the funding it needs to enforce the law, close the tax gap, and make sure that wealthy taxpayers are complying with the same rules as everybody else does. And I should note that funding is improving customer support for everyone, making it easier for our constituents to get help, to get answers, and to get their tax refunds. What we're talking about here is common sense and basic fairness. You don't get to ignore the law just because you're rich. Those big billion-dollar companies, I don't know about anybody else, but I never want to see a list of the largest companies in America that pay nothing in federal corporate income taxes again. It is just not fair. Wealthy Wall Street investors, they should pay taxes and play by the rules, just like the hardworking people in this country. Everyday Americans, they should not be stuck footing the bill for billionaires who can pay lawyers to run circles around the IRS instead of paying their taxes like everybody else. So I'm really glad, Mr. Chairman, that President Biden has put forward a roadmap to help move us even closer to a tax system where everyone pays their fair share. And I look forward to hearing more from the witnesses today about how we can do that. My question would go to Dr. Klossing and Dr. Yegan. The economic theory behind the Trump tax cuts was that cutting corporate taxes would rev the economy because these cuts would allegedly trickle down to benefit workers. Well, it's been almost 6 years since that legislation was passed. Do you think the Trump tax cuts are working as promised?
I'm happy to start. Thank you for that question, Senator, and I appreciate your earlier comments as well. The Trump tax cuts did raise deficits a lot. That's one thing we know for sure. If you look at the revenue intake from both the corporate and the individual level, it's much lower than it would have been. If you search for positive effects on investment or on the economic growth, they're very difficult to find. Research by the IMF and by academics has looked through the time series, and it's true that those tax cuts were passed during a time of very robust economic growth, and that robust economic growth continued, but you can't see an incremental effect of the tax cut on spurring investment, and that's particularly surprising because there was expensing provisions included as well as those massive corporate tax cuts. But I think one reason that we can point to for why it didn't have any positive effects on investment or growth is that the companies that were really benefiting from this tax largesse are companies that already had more than enough cash on hand to undertake any worthwhile investment, right? So if you've got a company that's earning above normal profits and you give them an even greater return, they're not going to have any reason to take that and invest it. Instead, we saw record stock buybacks, and we saw a big run-up in the stock market in anticipation of that legislation. So really, the shareholders are the ones who benefited from that.
Yeah. Dr. Yegan, you want to add anything? Okay. Thank you very much, Mr. Chairman.
Senator Johnson.
Thank you, Mr. Chairman. I think Dr. McBride pretty well laid out the solution here. It would be to simplify and rationalize our tax code. Unfortunately, we've done a pretty miserable job here in Congress of attempting to do that. But Dr. Yegan, Dr. McBride also laid out the facts according to the IRS in terms of what percentage of the total income the top 1% versus the bottom 50% make. So I won't repeat that. It is interesting that JCT looks at it slightly different. The top 1% of the floor of the income level there is $548,000 worth of income. JCT looks at people making over $500,000, and they say that they make about 22.7% of income, pay about 51.8% of total income taxes, 32.6% of total taxation, okay? So the question I have for both Dr. Yegan and Dr. Klausing, assuming the top 1% makes about 22% of the income, what percent share of the total income tax should they pay? What would that be a fair share? Because we always hear from the other side, what would be fair? Right now they're paying almost double. Well, according to JCT, they're paying more than double taxation versus income. What would be fair? When are you going to be satisfied?
Thank you, Senator.
And I want a percentage. I don't want to really, what percent? Should it be 51.8%? Should it be 60%, 70%, 80%?
You and your colleagues have earned millions of more votes than I have. I'm an economist, and I can speak to the economics of the policies. One key thing is that state and local taxes are actually regressive. And so when you talk to total tax burdens, they're pretty flat over the income distribution.
Dr. Klausing, what would you give me a figure on that? Again, I can never get this out of people. I mean, what would be a fair share? If you're making 22% income, how much percent of the income tax should you be contributing?
A lot of the statistics that you and others have raised on this issue concern labor tax burdens, and one of the things that both Professor Yegan and my own testimony point to is that there's a vast discrepancy between how we tax labor income and how we tax capital.
Okay, so
the
moves into my next. So again, JCT shows 23% of income, but about 33% of total tax.
Yeah.
So should that be 50% or what?
The top, according to Treasury data, the top 1% of taxpayers have 52% of the positive capital income, and that's the income that's really undertaxed, both at the individual level, as we see in Professor Yegan's.
Okay, well, I'm not going to get an answer. So let me move on. I think Dr. Yegan, you were talking about turning what you don't think is pass-through income. It's really salary type of income, and turning it into pass-through and avoiding the Medicare tax. I mean, is that correct? So I mean, an example of that would be, let's say you're being paid royalty on a book, which in that case I would actually, from my standpoint, having been a manufacturer operating pass-through income businesses, when you're making income off of manufacturing, I would think that's like real business income and should be treated as pass-through. But a royalty on a book, I would say that probably should be attributed to people as real, like, salary income. Would you agree?
Yeah, labor income.
So what you're talking about in terms of that tax dodge is exactly what President Biden did when he turned royalty income in through, I think it's subchapter S, into pass-through income and didn't pay the Medicare tax, correct? Now, that's what you're talking about in terms of people turning what should be Medicare taxable income into pass-through income, right?
Yes, and same for, a private practice physician or others. They're all legally using the tax code, and it's just
so let me ask you this question. Social Security is, we tax that, and there's a limit to it because the deal with Social Security is you're basically pre-funding your own retirement fund. I mean, that's I know it's not really what happens, but I mean, that's sort of wouldn't you say that's sort of the same thing true with the Medicare? That you're paying all your lifetime, you're paying the Medicare tax to provide your Medicare benefit, but we don't limit the Medicare tax, so I would argue that's somewhat unfair. If you want to, change the deal, that this isn't really a payroll tax for your retirement, Medicare then ends up just being a general fund type of program, correct?
If I understood the question right, so Social Security benefits are a function of how much you pay in. So the more I pay in, the more I get. Medicare is a flat benefit, and so that has different
Yeah, but
revenue.
again, if you're turning pass-through income where it could be in a business, could be millions of dollars.
Sure.
With no limit on that, you're paying an awful lot for healthcare in your retirement age. Let me just move on, because I think the other solution in terms of what you're talking about, trying to tax capital gains, which I think violates a basic principle of taxation, wherewithal to pay. Senator Kaine, I think, wrote favorably about what I was talking about in 2017, a true Warren Buffett tax, where we convert all business income into pass-through income and tax business income at the shareholder level. And I would do it based on a cash basis income. But wouldn't that also solve the problem? Now you're not going to have this buildup inside C Corps of non-distributed income. So if you just tax all business income at the shareholder level, by the way, I talked to Warren Buffett about this. I've talked to his shareholder services. It's entirely possible. You collect the tax on a backup withholding like you do the payroll tax. I mean, would you agree that that would be something we really ought to explore, some system like that?
There are multiple ways to skin the cat here. And, the Sinatra tax burden and the Walton tax burden is different now. What you can't do to equalize those tax burdens is both lower corporate tax rates and keep individual tax rates low. But as you say, if you would tax all corporate income in the year it's earned as ordinary income, that would equalize.
To the shareholders. And again,
Yes.
tax at the shareholder level. That's what we do. 95% of American businesses. So I'd love to work with the chairman in terms of working on that type of proposal, because it solves an awful lot of the problems that you're talking about here. So I look forward. We got a couple years to work on this, because unfortunately, 95% of American businesses are facing a severe tax increase in 2026, and that's all the small businesses, the people that are engines of innovation in our economy. So thank you, Mr. Chairman.
Senator Braun.
Thank you, Mr. Chairman. When I was here earlier, the discussion was about the fact that 20% of GDP is maybe some magic number in terms of where we should be generating revenue. I look at statistics. The most salient one I've seen is that over 50 years, regardless of the tax rate, we average about 17.5%, maybe 18% of our GDP. Our system is such that high tax rates, you're going to get a better fiscal out of the gate, but you generally kind of attenuate into a 1 to 1.5% economic growth rate. Lower rates out of the gate have a negative fiscal to it, which I almost got the CBO to acknowledge. We were paying for the Trump tax cuts, which were chump change back then, $150 billion per year for 10 years, $1.5 trillion. There you get a 2 to 3% growth rate. But how can we expect to tax into a level that, other than a couple years during the Clinton administration, it is so statistically stubborn that with our system as it is, we generate 17.5 to 18% of our GDP in federal revenue. Start with on the left and move to the right, and in like about 30 seconds to 40, because I got another question as well.
It's quite clear that our tax code does have a big impact on revenues. So if you look at both the Bush tax cuts and the Trump tax cuts, in both cases, they had persistent effects on deficits and debt in the long run. And there's a recent analysis actually at the Center for American Progress by Bobby Kogan that kind of traces through those. And if you look at the big contributors to debt in this country, there's two factors. There's the big one-time shocks of responding to the 2008 financial crisis, but also responding to the COVID crisis. Both of those caused level changes in the amount of debt. But also these persistent tax cuts have helped contribute to this fiscal imbalance that we see before ourselves.
So are you saying that
Yeah.
you would be able to generate consistently 20% of our GDP and federal revenues, where that's not been the case other than just a couple years when rates have been, higher?
I think there are very sensible tax policy reforms that can generate additional revenue to help balance the budget. And I think 20% of GDP would be a good target. It's a political process that determines exactly where you want to land that. But I think one thing to bear in mind is that the United States is a very low tax country relative to our peer nations, and a very high deficit country right now. And so we really need to look at all solutions to that. And that includes a more robust fiscal system that raises the tax revenue that's needed, and that's partly about funding the IRS. It's partly about leveling the treatment of labor and capital income. It's partly about leveling the treatment of domestic and offshore income, and all of those would contribute to reducing the deficit in a helpful fashion.
Yes, I would just echo that the United States, is below the median in terms of total tax revenues as a share of GDP among other peer industrialized countries. So, it can be done. And actually, Congress had enacted a pre-programmed rise in expenditures with an aging population, for my generation. And actually, I'd done the same for taxes too, the way that tax brackets were set up and other features of the tax code, which were then undone through legislation in the 2000s and 2010s. So I think there would have been a pre-programmed rise in revenues as a share of GDP had it not been for those acts that would have risen, above those historical levels.
Referencing the cross-country comparison here, the way these other countries are raising so much revenue than us, particularly in Europe, is primarily through the value-added tax, not through income taxes. We don't understand this concept here, of course, but we don't have a value-added tax. We have retail sales taxes at the state level. Value-added tax, essentially the same idea, but it's designed better so that it doesn't result in taxes on business inputs. Collects a ton of revenue. It's the primary revenue source in most European countries. The second way they do it is through higher payroll taxes than we have, and so these are both taxes essentially on labor income at the end of the day rather than capital income. So that is where the money is.
So, Dr.
terms of
McBride, do you
collecting
think we can generate 20% of GDP and federal revenues without depressing the economic growth rate? And then what's the trade-off there? And statistically, again, even before the Bush tax cuts and the Trump tax cuts, if you go back 50 years, we still only generate 18% of GDP in tax revenues.
I agree with you. There's an amazing sort of regression to that level, no matter what the top individual rate is. For instance, it's fluctuated quite a lot through the 80s and the 90s and through today. And I think it does point to a lot of behavior responses to those top tax rates. And one is what I described in my testimony about the economic incentives to work, save, and invest that are related to that marginal tax rate on those activities. And the other is reporting of income. So there's particularly with the higher capital gains rates we saw in the 80s, and then the changes in the 90s that brought the capital gains rates down. There was a huge response.
Out of time here, and I might note that our current spending is now not at 20%, it's about 25% of GDP. And when you look at nearly $7 trillion in our total federal budget, there's nothing that's going to lead to other than chronic deficits that regardless of the rate, we got to get that back down to where it is normal. I've got another question regarding Medicare.
I see.
Go ahead. Okay. So I've been probably the most outspoken senator that we got a broken healthcare system. It's like an unregulated utility in my mind. One side of the aisle maybe wants government to take it over completely. You're still going to be dealing with a broken system, just a payor that may have a little more clout. I found in my own business, and did this nearly 15 years ago, that there are ways, even though it's opaque, even though there are barriers to entry, there's not inherent competition built into the system. I did it from the demand side. And number one, we became the insurance company and saved about 25%. That's how much insurance companies were making on small businesses. But the biggest thing I did was turned all my employees into healthcare consumers, trying to draw out value in a system that doesn't offer it. That's the biggest part of our GDP. It's the part that has grown the most. And whether it's a private payor or a government payor, it's a broken system. What could we do, in your opinion, to reform healthcare, not by giving more of it to government or giving more of it to the private sector in terms of how you pay for it? What could we do by getting rid of all barriers to entry, full transparency, full competition to actually bring the cost down to where instead of being 18% of our GDP, imagine if we just got it halfway to the world average, which is about 12%, we're freeing up 4% of our GDP. That would pay for all of our deficits we currently run as a country, probably federally, and in terms of benefiting the private sector as well. Start on the same end and tell me what you think about that.
I think there's a lot of low-hanging fruit with respect to reforming the healthcare system to save money. I think there were some important steps in the Inflation Reduction Act to lower costs for seniors in Medicare and also for those consuming drugs like insulin. And I think those are important steps forward. I think there's a lot more that could be done. And there are proposals that the Biden administration has, but also others, in think tanks and elsewhere that I think should be thought of. I think you're right that insurance companies are responsible for a lot of those costs. And if you look at the difference between the American system and those abroad, like that extra layer of cost is very salient. And unfortunately, our healthcare outcomes are also worse than we see in other countries. So I wholeheartedly agree this is an area where we need more reform.
We can all agree with that. How much of my own time have I wasted on the phone talking to a health insurance company? There are definitely ways to align incentives, reduce paperwork burden, make sure that the plumbing works so that electronic records can save the time of insureds and physicians and their staffs. And competition does play a role. There is evidence that in locales with only one hospital system that consumers are hurt by that. So there's many ways to look at this, and we'll have to look at all of them.
Well, sticking to the tax space, the single largest tax expenditure, as documented by the Joint Committee and Treasury, is the exclusion for employer-sponsored health insurance. And so this is a full exclusion of any tax, any income or payroll tax paid at the entity level, the business, or at the individual level. This is the way it's been for decades. It's grown to be a tax expenditure that is costing several trillion, actually over a decade. So this is a huge pot of money here. I think we have to be careful with how we address it, but in my written testimony, I outline a reform that fully eliminates it, along with several other reforms. It is a large tax increase to subject that fully to income and payroll tax. We estimate it would raise about $4 trillion over 10 years, for instance. You need to offset that with some other reforms, tax cuts that smooth that transition for workers. But the problem with the current exclusion is that it creates a huge distortion in the healthcare market in which employers, our health insurance is, for most Americans, it's tied to our work. And furthermore, it incentivizes insurance companies and third-party payers to have a larger role than they otherwise would.
And with as hard as it's been to hire people, it's a very tricky area when you start messing with fringe benefits. I'd love for the senator and I to look at, in my own business, the key was minor health care. That's done through insurance. Scratches and dents were never meant to be part of an indemnification. And the key, when the insurance companies told me that almost all of the excess in health care is due to overutilization and the fact that you're paying insurance for minor repair, that should be directly between the provider and the individual, only qualified by those that can't afford it, to where you'd have maybe some type of health savings account. But the key was when we took minor health care out of being part of insurance, it started cascading all kinds of positive benefits, and insurance was never intended to pay for, in anything, minor repairs. And we need to think about that in terms of a way that would easily lower healthcare costs. Transparency, competition, little skin in the game from those that can afford it on their minor health care. I think you and I could single-handedly put a bill out there, Sheldon, that might get the movement in the right direction. How about that?
Mike, I would actually really like working with you on this. As you know, there's substantial overlap in our thinking and in our experience. Mine had a lot to do with reform work that changed the incentives for the industry and for the participant. And in particular, the one that flags for me is the accountable care organizations that were set up. I'm particularly proud of Rhode Island's 2 lead accountable care organizations. They were called Integra, originally Rhode Island Primary Care Physicians, and then Coastal Medical. And both of them were complete champs at lowering cost and delivering better care and dramatically improving the experience of their patients. In a small state like Rhode Island, if you've got a major private practice group that is improving the experience of its patients, you know about it. And for these 2 to be competing to be the best in the country, essentially, at all of this, they returned millions of dollars to Medicare as a result of these improvements. So I think there's an enormous opportunity here. A lot of it involves getting off of fee-for-service, getting skin in the game at a whole variety of levels. And I think the ACO model is one that has really proven itself. So let's keep going. I will share with you that something we've talked about privately, that we are trying to make sure that CBO, which this committee has some authority over, pays more attention to taking a look at how healthcare savings of that nature can be scored. Because as you know, I've got my little chart that I use that projects $7 trillion in healthcare savings. That's a pretty big number. I want to know why that happened, and I want to be able to do more of what caused it to happen. I think ACOs, healthcare reforms, getting away from the fee-for-service treadmill, paying more attention to quality and outcomes, all of that has had a role in savings. And you're absolutely right about the numbers. You're absolutely right about the comparisons to our foreign OECD competitors. We pay way more than the second worst one, we being the worst one, and we have just below average outcomes for that huge, huge cost. So, and it's a huge part of our deficit. And if we play this right, you're not taking benefits away from people.
No.
You are providing them better health care.
In our own business, we did not, because we took what we had then, lowered family costs by 50%, and have not had a premium increase in 15 years, and we have a healthier bunch of belly buttons, which they call it in the healthcare business, employees. So it can be done.
Yeah, I had a similar experience with our workers' compensation system in Rhode Island years ago, reforming that, and half of that is wages, but half of that is health care. And we made it work for both. We're 50% cheaper than we were beforehand without taking benefits away from people, just by making systems work better. So I really look forward to working with you on that, and I'm glad we had the chance with just the 2 of us here to have a longer exchange than hearings regularly permit. I want to add a couple of points in closing. The first is with respect to Senator Kane's point. I met with our taxpayer advocate while we were back over the break, and the taxpayer advocate has new employees because of the bill. So they're able to take more calls from taxpayers who have problems. Now, it's fine, they hired up quickly, but they're an intermediary with the IRS. And what they're seeing is that the IRS is staffing up now so that they're getting quicker responses and they can serve Rhode Island taxpayers better. It's not enough to have more people in the taxpayer advocate's office if you still have jam-ups in the IRS divisions. And they are seeing, as the hiring takes place, those jam-ups in the IRS divisions beginning to clear. So I am seeing what Senator Kane talked about also in Rhode Island, that service by the IRS is immediately and noticeably improving as a result of those added resources, and I wanted to add that to the record. I also wanted to get some more clarification from Dr. Klausing. You were talking about the difference between 22% of labor income and 52%, I think your phrase was positive capital income, and you got cut off in your answer. If you'd like to finish while Senator Kennedy gets himself in his seat, I'll turn to him as soon as you're done with your answer.
Thank you for that, Senator. The data I refer to are available on the Treasury website, and it looks at the distribution of different forms of income. And the top 1% of the distribution has 52% of the positive capital income.
Meaning what? Positive capital income is what?
Positive capital income is income that originates from, not from labor, but that also kind of takes away in the analysis people who may have had losses, right? So if you just focus on those that are earning above zero as opposed to losing money, which is kind of a nice kind of snapshot view of those who have gained from positive capital income. And I think one thing that the testimony of both Dr. Yegan and my own testimony point to is the ways in which our tax system as a whole fails to tax capital income adequately. And it's a difficult problem to fix. I think the entity level of taxation or the corporate taxation has an important role to play because a lot of capital income isn't taxed at the individual level at all. If you look at income that's held in pension or retirement accounts that are tax preferred, or income held in foreign hands that may or may not be taxed by the foreign government, the U.S. government doesn't reach any of that capital income for individual taxation. When it does reach taxed accounts, that tax is often deferred indefinitely or perhaps forever due to step up in basis at death. So if you can first tackle capital income by looking at the business layer of taxation, that's your first attempt to get a really a wholesale approach to reaching this income. And then also reforms at the individual level are helpful as well. But that can help raise the amount of revenue that we can achieve and close deficits without resorting to higher labor tax burdens, right? Because that differential between labor and capital is causing a lot of the problem because it leads to a lot of avoidance and less revenue than you would get.
Senator Kennedy.
Thank you, Mr. Chairman. Dr. Yegan, am I saying your name right? Tell me, if you were king for a day and you could rewrite America's tax code, tell me the 3 changes you would make.
Number one, I would equalize labor and capital tax burdens at the top. There are a couple ways of doing that. The billionaire minimum income tax is one that would move in that direction. I won't rehash those details. Senator Johnson actually talked about a corporate tax integration type.
What's number 2?
Sure. Number 2, part of closing the labor and capital disparity is closing the Gingrich-Edwards loophole. And number 3 is ending abuse of trusts. So the estate tax has been eviscerated. Many of those, you take assets that you know are worth a lot. Right now, they're purportedly worth a little because you haven't taken your company public. You put them into a trust, it explodes.
Do you support a wealth tax? Do you know what I mean by wealth tax?
I do know what you mean by wealth tax. The billionaire minimum income tax taxes income, and that, I think, is the way forward in that space.
Well, let me be a little more precise. Do you think appreciation of assets that are not sold, unrealized gain, should be taxed?
I think you should have to prepay tax on it that will eventually be due at sale, gift, or bequest.
What do you mean prepay the tax?
Sure. So if I have $5 billion of unrealized capital gains, I have $5 billion of taxable income, and I'm currently paying $1.5 billion on that. So that's a 15% overall tax rate.
Well, let's don't complicate this. I want to understand
Sure.
what you're saying. Let's suppose an American owns a piece of real estate they inherited from their father or their mother. And it was, when they inherited it, they got step up in basis, it's worth $100,000. And all of a sudden, the interstate came through. And the property is now worth $1 million if they sell it. But they don't plan to sell it. They're going to leave it to the kids. Do you think that Americans should have to pay tax on the unrealized gain, the increase in value?
In general, no. At that level of wealth, for example, housing.
You think only wealthy people should?
At the very top, it's hard to tax,
But let me be sure I understand what you're
Sure.
saying. All right, let's suppose that's not just an average American. Let's suppose that's an American. What do you define as rich?
In the minimum income tax, it's $100 million of wealth or more. That's
Okay,
the-
so you think if you're really wealthy, you should have to pay a tax on your unrealized gain?
I think you should have to partially prepay if you're liquid, if you have liquidity to pay.
Do you think somebody, why can't you economists answer questions? Should any American have to pay tax on unrealized gain? Why can't you just answer me?
Yes, there are some who should.
Who?
The ultra wealthy who have liquidity should prepay some tax.
What
on
if they
that.
don't have liquidity?
They should not have to pay, and they will owe at sale, bequest, or gift
So if you have cash, you ought to have to pay, but if you don't have to pay?
to prepay. I have in my testimony, there are examples of how this works so that you can preserve incentives to build a new company, take it public.
Okay,
While
what do you
also-
think, Dr. McBride? Do you think we should start taxing unrealized gain? And what do you think that'll do to the economy?
Well, I have several concerns about the approach. The first of which is it's completely untested. It's never been tried in this country. We have more than 100 years of history with the income tax, and
Europe's tried it, haven't they?
no, they've tried wealth taxes.
Yeah.
Their experience
How'd that
with
turn
wealth
out?
taxes has
How did that
been
turn out?
bad. It
Why is
resulted
that?
in a lot of taxpayers exiting the country, for one thing. In France, for instance, other countries that have tried it. And you suddenly lose a big chunk of your tax base that you're trying to tax there. We have that option in this country as well. The result has been that most of those countries in Europe that have tried a wealth tax have rolled them back,
Yeah.
including France, because they were administratively challenging. The basic challenge is what you're describing, trying to value assets without real market transactions. So this is a valuation dispute. It means we get the IRS engaged in yet another challenge. They're currently doing this with the estate tax. Those estates that are subject to the estate tax, those valuation episodes can go years and years and years.
Can I have 30 more seconds?
Proceed.
Dr. Is it Clausing? Clausing?
Yes.
Yeah. Why do you and Dr. Yagan, why do y'all want to punish wealthy people?
I think I can speak for both of us that we're not interested in punishing anyone. We're interested
Well,
in
you're
having
interested
a
in taxing
fiscal
the hell out of them
system.
more than anybody else.
I think
Why,
the
what makes you
reforms
think?
that Professor
What makes you think that making tax policy on the basis of class or status makes sense?
I think it's a very American phenomena that throughout the history of the income tax, we have valued progressivity, and our current income tax does that. We used to rely on things like tariffs to raise revenue. Tariffs are regressive consumption taxes that disproportionately hurt the poor. We believe in this country that those with the greater ability to pay should pay more of the burden. And that's part of what a healthy capitalism does. It enables people to gain from things like trade and technological change and business innovation, and to contribute a little more to the fiscal system when they're very successful in doing so. And I think that that's a very legitimate way to structure the tax system.
Can
And
I ask you a question?
Yes.
Why do you think so many wealthy people are leaving New York City?
New York City is, an incredible city of innovation, immigration, entrepreneurship.
Yeah, but why are so many wealthy people leaving?
I think there are big advantages to living near centers of entrepreneurial activity, and we see that on the West
You think
Coast
they're
as well.
leaving to be nearer to centers of entrepreneurial activity, do you?
Well, I don't think there are a lot of people, fleeing New York City. That New York City has.
Sure they are. There are thousands. I mean, there have been study after study after study. Why are so many wealthy people leaving New York City?
I think there's an enormous number of wealthy people who are in New York City and continue.
But why
to
are so many leaving?
I can't speak to why particular people
I can
leave.
tell you
I
why.
know
It's
that-
taxes. You know that as well as I do. It's
I
taxes.
think if you look at the economic,
Some of it's crime, but most of it is taxes.
well, you know,
People vote with their feet. The same reason that people are leaving California and moving to Austin.
if you look at California, it's one of the most successful economies in the world, and it continues to be so. It attracts people.
But they're
as
losing
well.
people.
I don't think it's in any danger of decline, nor is New York City. And these are very vibrant places.
I don't think we're going to
for
ever
fundamental
agree.
reasons. Yeah.
I don't think we're going to ever agree. But I appreciate the time of all three of you.
Thank you.
To be fair, there also are people moving the other way. There are people who move to New York. They just don't all leave from New York. It's a two-way street in and out of New York. And it's a two-way street between Austin and California. People leave Texas and go to California, and some of them do very well.
Well, that's true, Sheldon, but I can show you study after study after study, as you well know, and as the professor knows, that shows that people are leaving high-tax states and moving to low-tax states. All you have to do is
Well, they
look at
also
the-
leave,
all you have to do is look at the demographics. Pick the 9 states that have, say, a state income tax, and compare that, or that don't have a state income tax, and compare that to the states that do. It's called tax avoidance, and there's nothing wrong with it. It's perfectly legal.
People have different preferences. You know, if you look at where immigrants choose to live in the United States, they often go to those same places that you were talking about. You know, so I do think that, you know, there's movement in both directions.
Yeah, but here's my point. Here's what I think rational people do, and here's what I bet all three of you would do, and I bet Sheldon would do it because he's a smart guy. Okay, if he won the lottery tomorrow and won $10 million and paid his taxes and has $6 million left, he's going to at least consider, you are too, moving to Florida because
No, I
they don't have a
wouldn't.
state income tax.
For the record, no, I wouldn't. Never crossed my mind.
Well, most rational, well, I don't mean you're irrational, Sheldon, you know that. But,
It can be quite rational to not want to
But
live
when
in
you're
Florida right
liquid,
now.
when you're liquid, and you don't have to pay a 6% off the top versus 0%, it's a rational economic move, is it not?
I agree it's rational. I mean, the thing about taxes that we're talking about is they're a cost or a price. And so claiming that this cost or price doesn't matter is essentially throwing out the very basic law of demand, the basic fundamental idea in economics. The prices matter, the costs matter.
See, this is what this always boils down to, and there's no way we'll ever agree, okay? But at least two of you believe that government, all things being equal, can spend a dollar better than people can. And that's your this is America. You can believe that.
For the record, that's not in their testimony.
I just don't agree with you. I think people can spend the dollar better, all things being equal. And all you have to do, if you know the history of government, you know that I'm right. But I don't expect you to agree with me because you're professors. Okay? Thanks, Sheldon.
Always entertaining. Senator Kennedy, thank you so much for being here. Which kind of, just to close out the loop here, takes us back to the question of offshoring. If we allow companies and wealthy Americans to avoid paying taxes by going offshore, we can assume that they will follow that incentive, at least many will. And where there are negative effects on the country by allowing that to happen because jobs have moved offshore and revenues that would otherwise support American initiatives are lost, that's a problem that needs solving. And I think that's a large part of what Dr. Clausen's testimony is about. Dr. McBride, we have had a witness from the, chosen by the Republican side, say that it's very important that in order to evaluate a witness's testimony, you have to know who's funding their organization and their research. So I think that's a logical thing to follow up on. And it's my understanding that the tax foundation almost inevitably argues for lower corporate tax burdens. Is that correct?
That's correct. As my testimony describes, the corporate tax, according to many studies, is very economically destructive. That's the primary reason why we argue against it. This is dozens and dozens of studies by OECD researchers and others that find it's the most damaging tax.
And your board is made up almost entirely of corporate executives and corporate lawyers?
Have to think about that. We have a variety on our board. It's on our website.
And it's not clear who funds your organization because there's a lot of non-transparency. So I'm going to ask the question for the record, if you'd go back and let us know where the financial support for the tax foundation comes from. I don't expect you to have that off the top of your head, but when donations come in from groups like Donors Trust, you don't know who the real donor is, because Donors Trust is simply a pass-through vehicle for removing the identity of the true donor and masking it behind the label Donors Trust. So if you could take that question for the record and answer it how you wish.
Happy to review that request when it comes in.
Very good. With that, I think we have an additional, so your questions for the record are due by noon tomorrow. And if you can take mine as a QFR, we'll also get it to you. The answer we'd ask witnesses to get within 7 days of receipt when we get it to you. And I want to thank the witnesses for appearing. Their entire full testimony will be included in the record. I think it is extremely important that we decorrupt and de-rottenize our tax code. And where it has been structured over many, many years to favor the wealthy and allow them to pay lower tax rates than regular working Americans, I think we have a problem on our hands of propriety. I just think it's wrong. I think we have a problem of economic injustice. I think we have a problem of an unfortunate circularity between wealth and political influence, using political influence to create more wealth for those people who already have it. And as we've pointed out, there's also a problem of revenue. And while we're running deficits, to run an unjust tax system that creates bigger deficits for the sake of wealthy political influence is not a good place for the United States of America to be. So with that, we are concluded. I thank all the witnesses.